The reason why a lot of traders fail or don't get to the next level of where they're making consistent money is because of stops. So we obviously have to have stops in trading. You cannot trade without stops, but you want to use a different type of stop to what a lot of people are using. The reason for that is that market makers will often go for obvious stops in the market because the markets are there to maximize trade. They're there to facilitate trade and match up buyers and sellers. So when trade volume is pretty low, the market makers will often shift the market to an area where stops are clipped. So you don't want to be putting your stop in an area which is obvious, because then you're getting into the churning stage where you'll make a win, then you'll make a loss, then you'll make a win, then you make two losses or whatever. Maybe then you'll make a big loss. And you're really just churning your account. And I believe it's because of stops. People are using the wrong stops. They're putting them in obvious areas where the market makers see a big cluster of stops, and the market will come down, clip those stops, and then they'll get on with their move. So how can we get around this? Well, what you can do is you can add a nominal amount onto your stop level. So just say you wanted to put a stop at 6,000, for example, on the FTSE. It's a big round number, and that's where you feel that you should put the stop. It's a very obvious area. So what you could do is then just maybe have a nominal amount of 15 points, which you add on to your first obvious stop level that you think about in your mind. Because generally the stop level that you think about is also going to be the level that all the retail market are also thinking about. So do something with counter intuition. So put your stop somewhere where the herd are not putting their stops, and you're less likely to get clipped out of a trade. So that's one thing. Add a nominal amount onto your obvious stop level that you're thinking of. The other areas I'm going to look at on the charts now. So one is called acceptance. So let's now go over to the charts and have a look at what acceptance is. All right, guys, so this is a FTSE chart. And actually, let me just go over to a 5-minute chart. It's easier to use. So actually, with my reports this week, we've actually been looking at 6050 as a real key level in the market. So what we've been telling our clients all week is that above 6050, the market is bullish, but below 6050, the market is still bearish, and we're likely to see downside in the market. We'll look at my report actually in a second, and you'll see what I'm talking about. But you'll see all week we've seen this action. We've seen the market bobbing up to around 6050, and it's been rejecting. Now, the obvious level, if you were selling this market, say at 6030, if you read my report, would be to say, well, I'm going to put my stop at 6050 because Mark said that the price action below there is negative. So if it gets above 6050, then I should come out. So the retail market would either be putting their stop at 6050 or maybe a break above there. So if you'd done that, you would have actually got stopped out only to see the market move all the way back down lower in the day. So actually you were right with the analysis, but your stop placement has triggered you out of the market. So what you can do is you can use a method called acceptance. So what this is you wait for a 5-minute bar. Now this is for short-term trading. I'll talk about long-term trading in a minute, but for short-term trading, you can use a 5-minute chart. And what you do is you wait for a full 5-minute bar to close above the key level in question. And once you've seen that, it requires a 2-pip break beyond that level. So you'll see in this example that this bar here was not fully above 6050.